Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. I hope this new setup is unrivaled. Tried to up my audio and visual game, so if you like it, please make sure to hit that thumbs up. And today we are talking about Warby Parker, which is expected to go public very shortly in the next few hours. The ticker is WRBY, Warby. And it's a pioneer in the eyeglasses space. They've definitely grown very quickly, taken market share. I like their value proposition. It's cheaper glasses than what you can get, let's say, going to a traditional lens crafter. Much more affordable for good-looking eyewear. And so they've grown quickly. They have a reasonable enough value proposition. That said, what I'm sort of struggling with is their very rich valuation. They're expected to come in around $5 billion market cap. And, what's that look like in terms of the risk reward? I don't think it's super compelling, despite the fact that they have a strong value proposition and I think could continue to grow for a good clip for years ahead. Now, for the Peter Lynch type of investors out there, there's a lot of folks that say, hey, if I, buy the product myself, or I like the product myself, I should buy the stock myself as well. And so there's a lot of folks like that. So I can understand those, maybe nibbling in the Warby Parker shares. That said, it's just not for me at this point. Let's dive into to understand Warby Parker in greater detail. And so as we look at them, what we're looking at is this $40 price that's expected to go public at. That's around $5 billion valuation. That is pretty rich. It wouldn't surprise me to see this actually trade lower, given the fact that you see folks, effectively saying, hey, don't buy this direct listing. That said, they are disrupting the glasses industry, with a cheaper, I'd argue, better offering, talking about glasses starting at $95. And customers generally love it. You have this extremely sky-high net promoter score where customers are effectively saying, yes, I would recommend this to my friends, and you can see the reviews that folks have left. And their approach is saying, look, we're agnostic to where you want to buy it. We want to just meet you there. And so they have this omni-channel sales approach with a range from new retail stores to offering virtual try-on. So that way you could be using their app, and then it's like, what do these glasses look like on you? And then it's like, well, wait a second, do you even have a prescription? Oh, now we're offering telehealth prescription services as well. So that way you can get the prescription, straight from their telehealth app. And 95% of their sales are from glasses. So this really is a glasses company at this point, Warby Parker. That said, they are making these inroads into eye exam, contacts, and other eyewear accessories. Now, this did surprise me a bit because I thought they were truly the pioneer in online, but I think what they realized is that this is an experience where a lot of folks like to physically feel it, to see it, virtual is nice, but they want to feel the physical goods. And so in the last few years, they've been growing their physical store, their retail store count. And interestingly enough, pre-COVID, retail was the vast majority of their sales, nearly 70% of their revenue going through retail. Now, in response to COVID, that did flip, but currently it's around 50-50 as folks are getting a little more comfortable going back into stores. Now, is this unrivaled? And regular viewers know I sort of look at every company through a very, very straightforward framework, sort of three boxes, and then I dive deeper if it sort of passes these three, which is one, are you unrivaled? Two, do you have this huge market to sort of tap into? Can you grow at a high clip in the future? And then the third component is valuation. So unrivaled, huge potential and valuation. And as I'm looking at this company, I'm looking at Warby Parker, it is not unrivaled. You can just go to Men's Health and you can see, that it quickly pops up the 10 best places to buy glasses online. And they're not even the number one, when you go to that article. So they're not unrivaled. That said, they do show signs that they have an extremely strong value proposition, given the fact that they're growing significantly faster than the industry, where they're guiding to something like 35% growth this year. So they're definitely taking market share versus the expensive legacy incumbents like LensCrafters. So they're doing something right. This value proposition where customers love it, it is working. And I didn't even talk about how there's a lot of repeat customers here, but that is a core aspect to this business of like, hey, you please your customers enough, they're going to keep coming back. And they're tapping into this huge industry. So not giving them like a grade A unrivaled. I'm saying, strong value proposition though. But they do get a grade A in terms of operating in this huge industry with a ton of potential, where the U.S. glasses market is estimated to be about $20 billion plus. The global eyewear market is around $140 billion plus. And they're saying, look, we only have around 1% of the U.S. market share given our low price point versus the rest of the industry. So we are taking share, and this is a huge opportunity for us in the years ahead. So I definitely think it's possible for them to continue very strong growth for the years ahead, 20 to 30% plus annualized for the years to come. That's what I would expect given their relatively more affordable option relative to the incumbents that are much more expensive. So what about valuation? Here it is. I'm going to do a quick plug where, once again, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy learning about potential multi-baggers, please make a point of hitting that thumbs up, hit that subscribe button. Multi-baggers are types of stocks that could potentially go up hundreds or even thousands of percent over time. And so, if you want to follow my personal journey, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. By the end of the month, I call out a potential multi-bagger. And we also have a dedicated online community at Discord with fellow like-minded investors where I'm interacting on a daily basis. So that's for the folks that are interested. But let's go back into understanding what's going on here. As we're looking at Warby Parker. And so as we look at them, the reality is, yes, they are this really strong brand that's resonating with consumers, but they're really still very far away from the optimal margins in which you'd value this, saying, hey, this is the margins that they're going to get longer term. I mean, this business is still operating at a loss despite the fact that it is a consumer product doing around $400 million in revenue. Now, what about their long-term margin potential? Because clearly you're not going to value them based on, a PE ratio when they're operating at a loss. You're going to value them based on what do you think this business could earn in the future, and how would investors think about that? And so it is worthwhile. They do break this down in a helpful way, sort of showing, hey, our average order per customer has gone up from around $190 to around $220. You can see that the raw cost of goods, whether or not it's the product cost, the optometrist salaries, the store rent, all these things, these product costs, this is around 40% of those sales. And then how do you get the customer's interest? And so that's around 20%, somewhere between 15 and 20%. And so then, if you factor in, okay, so now you have to have direct selling and service costs, the store salaries, the customer experience salaries, credit card processing, that's another 20%. I don't see them getting a lot of leverage here over time. I think they could get some leverage on acquisition costs as they become a better known brand. Maybe this is a percentage of revenue goes back down to 10%. And so this ultimately leads to contribution per customer of around, you could see around 40, $50 a share, $50 per, per new glasses or per order of $220. But that's around 20 to 30% margin. So maybe that gets a bit higher. Keep in mind, this is before their major corporate expenses, which are very real. Think about the R&D of their website or just general corporate. And so as I'm looking at sort of the framework here, and keep in mind they're guiding to around 35-36% growth and their expected $40 share price, I just don't see the $5 billion valuation as super compelling. I'm effectively looking at, maybe 50% upside, 50% downside ballpark, just based on sort of the rough math, sort of saying 35 to 40% growth this year. Maybe over the ensuing 5 years, you grow at 20 to 30% annualized and end multiple 5 years from now, because this is a consumer product good, and ultimately there are a lot of competitors, particularly in the online space, maybe an end multiple 20 to 25 times. So I'm looking at this, not super compelling. Now, of course, this is a framework. Could the stock price go way higher, way lower? Of course. If you have an opinion on this where you're like, Daniel, I think the potential here is for them to be much, much better than this, I'd absolutely love to hear it. If you're like, Daniel, you're missing this aspect, and this is why this is an incredible growth story, or when they launch internationally, their growth is going to accelerate significantly, I'd love to hear your take, especially if you think my margin assumption's wrong. Like, I'm assuming their end margins in this, in this sheet that you're looking at here, that's 15 to 20% that I'm penciling out. That is way more than what they're currently doing, where it's currently at a loss. So that is where I'm giving them a lot of credit in terms of that, in terms of thinking about that. Now, if you're interested in looking at some of the other companies that I call out exclusively for my Journey subscribers, go to unrivaledinvesting.com, where just earlier this month, a lot of folks are getting nervous about the market, sort of seeing their high growth, very expensive high growth names really take it on a chin. Some of them are down 5-10% in a day. I called out a very super stable oligopoly business earlier today, one that even if there's a recession, because let's say oil prices jump or interest rates jump, I called that out exclusively to Journey subscribers, where it's a company that I think it's super stable and can compound at 20 to maybe 30% annualized in the years ahead, just given how stable and how cheap it is at around 10 times, a little under 10 times free cash flow. So, but that's exclusively for Journey subscribers if you're interested. And, at the end of the day, if this video learning about Warby Parker has been helpful for you, if you like the new setup here, give me, I'd appreciate that thumbs up. If you have any sort of feedback, if I'm missing anything with Warby Parker, would definitely love to hear it. And thanks so much for watching.